Good evening. In the world of global finance, some moves are impossible to ignore, like China's recent rapid sell-off of U.S. Treasury bonds. This isn't just a routine adjustment, it's a move that's sending shockwaves through financial markets and making investors, economists, and policymakers sit up and take notice. For decades, China was a top foreign holder of American debt, helping keep U.S. interest rates low and fueling economic growth. Their massive purchases of treasuries have long been a stabilizing force, supporting the dollar and making it easier for the U.S. government to borrow money at affordable rates. Now Beijing is sending a clear message: the era of quiet economic partnership is over. The relationship is shifting and the world is watching closely as the two largest economies drift further apart. This isn't just about numbers on a balance sheet, it's a strategic shift that could impact everything from U.S. mortgage rates to the price of goods worldwide. The ripple effects could touch every corner of the global economy, from Wall Street to Main Street. The U.S.-China relationship, once built on mutual benefit, is being upended. Tensions over trade technology and geopolitics are now spilling into the financial arena. China's actions raise urgent questions that go far beyond the trading floor. Is the US dollar's dominance at risk? Could this be the first step toward a new global financial order, where the dollar is no longer king? Can America keep financing its spending? With national debt at record highs, losing a major buyer like China could make borrowing more expensive for everyone. Is this a warning shot, or the start of a deeper conflict? The stakes are high, and the world is watching for the next move. The stability of U.S. Treasuries, long considered the world's safest asset, is now in question. Investors are wondering if the old rules still apply. If foreign demand for U.S. debt dries up, the consequences could hit American households, businesses, and government programs. Higher interest rates could mean more expensive loans, less investment, and tighter budgets for families and communities. This is more than a headline. It's a strategic power play with global implications. The financial world is holding its breath, waiting to see what comes next. Is this a temporary tactic in a trade war, or the beginning of a historic split between two superpowers? The echoes of past confrontations are hard to ignore. The stakes are enormous, and the outcome will shape the world for years to come. Every decision made now could have lasting effects on global stability and prosperity. Tonight we break down what's happening, why it matters, and what it means for you. Let's dive in and explore the real impact of China's Treasury sell-off. To understand China's move, we need to revisit the rocky history of U.S.-China economic ties. For years, China produced and America consumed, a relationship that lifted millions out of poverty and filled U.S. stores with cheap goods. But beneath the surface, tensions simmered over trade imbalances, intellectual property, and currency manipulation. The real rupture came with the U.S.-China trade war, which exploded in 2025 when the U.S. hiked tariffs on Chinese goods to 145%. China hit back with its own tariffs, shutting down trade channels and escalating hostilities. Diplomatic talks froze, and economic warfare took center stage. In this climate, China's Treasury sell-off isn't just financial, it's a direct response to weaponized trade. The stage is set for a new kind of confrontation. The numbers tell the story. Behind every data point is a decision, a strategy, and a ripple effect that reaches far beyond the trading floor. In 2025, China's U.S. Treasury holdings plunged to $700.5 billion, the lowest in 16 years, down $71.5 billion in just 1 year. This dramatic drop sent shockwaves through global markets, raising alarms among investors and policymakers alike. The sell-off accelerated after the April tariff hikes, signaling a deliberate policy shift. It was no longer just about economics, it was about sending a message. This isn't a market blip, it's a calculated move to pressure Washington. Every sale is a strategic play in a high-stakes game between two economic superpowers. By selling treasuries, China aims to destabilize U.S. financial markets and raise borrowing costs for the government and consumers. The impact is felt on Main Street as well as Wall Street, affecting everything from mortgages to business loans. The message is clear. China is willing to absorb the costs to show it has powerful financial weapons. This is a demonstration of resolve, not just a reaction to policy. U.S. Treasury data is public, so every month, the world sees China's leverage in action. Each new report is scrutinized by analysts, governments, and markets worldwide. The steady reduction in holdings is a warning. China can hit the U.S. where it hurts most. its financial system. The consequences could be long-lasting, reshaping the balance of global finance. This is economic statecraft, not just portfolio management. Every move is calculated, every response carefully weighed. The world is watching, and so is Wall Street. Investors, governments, and ordinary citizens are bracing for what comes next. The question, how far is China willing to go? What risks are they prepared to take to achieve their goals? And how will the US respond? The answers will shape the future of global finance for years to come. The market's response was swift and dramatic. After the April tariff hikes and China's bond sales, the yield on the 10-year US Treasury spiked by 0.5 percentage point, the biggest jump in 5 years. This surge signaled panic: more supply, less demand, higher borrowing costs. Investors scrambled, stock markets wobbled, and the dollar fluctuated as fears of a financial war grew. For American families, this meant the threat of higher mortgage and credit card rates. Some of the chaos was amplified by hedge funds forced to sell, creating a domino effect. The episode was a stark reminder. When geopolitics hit the bond market, stability can vanish overnight. The world's safest asset suddenly looked vulnerable. The message to Washington and Beijing was clear. Financial markets are now a front line in their conflict. The stakes are real, and the risks are rising. China isn't alone in reducing its US Treasury holdings. Other BRICS nations, Brazil, Russia, India, and South Africa, are quietly cutting their exposure too. Even Saudi Arabia has trimmed its holdings. The goal? Reduce reliance on the US dollar and shield their economies from American policy swings. This de-dollarization trend is gaining momentum. Yet, here's the twist. While central banks are selling, private foreign investors are buying. Total foreign holdings of US debt actually rose to $9.25 trillion, thanks to strong demand from investment funds and corporations. The result is a split market: official sellers on one side, private buyers on the other. The dollar's dominance isn't collapsing yet, but the long-term shift is unmistakable. The question: how long can private demand offset official selling? If the trend accelerates, the balance could tip. The world's financial architecture is evolving, and the outcome is far from certain. The next moves will be critical. As countries sell US Treasuries, they're not just holding cash, they're buying gold. Central banks are on a gold-buying spree, seeking safety from currency volatility and US policy risks. In 2024, central banks made up over a fifth of global gold demand, a record high. Surveys show most expect to keep increasing gold reserves while cutting dollar assets. Gold offers neutrality and security. No counterparty risk, no US control. For nations seeking independence from the dollar, gold is the ultimate hedge. Cryptocurrencies, despite the hype, aren't on central banks' radar. Gold remains king. The message is clear. In uncertain times, trust in gold endures. The world's oldest safe haven is back in the spotlight. Why is China selling? Experts are divided, and the debate is heating up as the world tries to interpret Beijing's true intentions. Some say it's a weapon. China is using its US debt holdings to inflict pain and gain leverage in trade talks. By selling off treasuries, Beijing could send a strong message to Washington, signaling its willingness to use financial tools as part of a broader geopolitical strategy. By driving up US interest rates, Beijing can pressure Washington at the negotiating table, making borrowing more expensive for the US government and potentially shaking investor confidence. Others argue it's a defensive move, a gradual shift to diversify reserves and reduce exposure to US risks. With global uncertainty rising, China may simply be protecting itself from future volatility or sanctions. Selling too fast could hurt China too, by devaluing its remaining treasuries and strengthening the yuan, making exports less competitive. The risk of self-inflicted damage is real, so Beijing must tread carefully. Another theory: the sell-off was amplified by market panic, not just state policy. Sometimes investor fear and speculation can accelerate trends far beyond what policymakers intended. The truth? It's likely a mix of all three: strategy, caution, and market forces. No single explanation tells the whole story, and motives may shift as conditions change. What's clear is that China's actions have global consequences, rippling through markets from New York to London to Tokyo. The line between financial weapon and warning is thin, and both sides know it. Every move is watched, every signal analyzed for deeper meaning. The world is watching for Beijing's next move, as governments and investors brace for what could come next. Will China escalate, or is this the peak? The uncertainty keeps markets on edge, fueling speculation and debate. The debate continues, but the risks are real. Every decision carries weight, and the world's financial stability could hang in the balance. The stakes couldn't be higher, and the outcome will shape the future of global finance. Washington's response? Calm, at least in public. Treasury Secretary Scott Bessent insists there's enough global demand to absorb China's sales. He points to rising private investment in U.S. debt as proof of market confidence. The message: China's actions are serious, but not an existential threat. Behind the scenes, officials are watching closely, running stress tests, and preparing for worst-case scenarios. The challenge: project confidence to avoid panic, while quietly bracing for turbulence. Publicly, the U.S. refuses to show alarm, denying China a visible victory. It's a high-stakes game of economic poker, with both sides holding their cards close. For now, Washington's strategy is to stay cool and keep markets steady. But the risks are real, and the situation is fluid. The next move could change everything. As 2025 ends, the rules of global finance are being rewritten. China's Treasury sell-off marks the end of an era and the start of a new, uncertain chapter. Is this a short-term tactic or the beginning of a permanent split? Both sides face risks. China could hurt its own assets. The U.S. could lose key investors. The world is watching to see if private buyers can fill the gap, or if a true funding crisis looms. The outcome will affect borrowing costs, trade, and the balance of global power. Gold's rise and the dollar's slow decline are signs of a deeper shift. We're living through a pivotal moment, with decisions in Washington and Beijing shaping the future. Stay informed, stay engaged, and consider what these changes mean for you. Good night.